Good afternoon, everyone.
Good afternoon, sir.
This is with respect to the assignment that I had floated yesterday. Any updates on that? Have you been able to form a group? Have you selected any sector?
So some of them have formed groups, sir. Some of them are not yet.
Have you formed a group, Rashmi?
Yes, sir. Our group is formed. So is it okay if there are 6 people in a group, or it has to be only 4, sir?
See, why I selected four is basically we have 9 sectors. We'll have 9 sectors otherwise. See, altogether the class strength is 35, 36, right? So out of
Yes,
36,
sir.
if I have to divide you in a batch of four, I get around 9 teams or 9 groups, and we have around 13 sectors. So you can select any one sector, and you can analyze.
Yes, sir. And there's one more doubt regarding stock prices to be taken, sir.
Yeah,
Because when we open it, there are many prices which are being shown, sir.
right. So for that, I will give you a live demo as to how do you download that particular data.
Yes, sir.
Okay. So if you want that, I will be able to do that also. So what I will do is,
Yes,
after
sir.
I finish my today's class, I will give you a demo. Okay, we'll re-log in. It's just for 10 minutes. I'll re-log in. All of you re-log in, and I'll tell you how to download the data from NSE website. Is that okay?
Yes, sir.
Okay, fine. So let us see how many people are joined. Yeah, there are 10 people. So we'll start the class. Yesterday we discussed about what are the various risks. Sorry, 2 days back we discussed as to what are the various risks that are associated with bond prices. Okay, or bonds. Today, what we are going to discuss, we are going to discuss how to put a value, how to put a price tag on the bond, right? This is very important because why is this important? For the simple reason we have said that interest rates are inversely proportional to bond price, and that is the reason we need to know how do we put a price tag, right? How do we put a price tag, or how do we ascertain the value of a bond? And that is the reason why we need to study the bond pricing or the concept of bond pricing. Are you able to understand now? In plain and simple words, bond price is nothing but it's a very simple equation that we have to understand, and that is what I'm going to tell you. But before that, you need to know what is the theoretical concept of how a bond price has been ascertained. So a bond price, okay, is basically it's a very simple concept to understand, provided you get the basics right. So there is something called as the common there's something called as the what do you say the present return or the current return, and there is something called as capital return. I hope all of you have know this. There's something called as I just put this. There's something called as a bond. Okay, and in your previous classes I think you have studied something called as the current return. You have studied something called as current return, and then you have studied something called as capital return, right? This is what you have studied. And when you add these two, what do you get? You get your total return. I think this is what you have studied. Okay, this was the formula that this is what we studied in the previous module. Okay, so here I think you have studied a formula called as ending price minus beginning price. Okay, the whole divided by beginning price. I think this is what you have studied as far as capital return is concerned. And as far as current return, I think you have studied dividend divided by the beginning price of the share. This is what you have studied. Clear? Now, we apply the same concept. We apply the same concept. Only thing is the words get changed. The only thing is that is a concept where there are some concepts wherein the word gets changed, and we call this particular term by one method or one name, and we call this particular method by another name. Okay, and that is what, if we add these two, whatever answer that we get, it is nothing but it is the price of the bond. That is what we have to ascertain. Okay, now let us come to the definition part of it. So the price of a bond is found by adding together the present value of the bond. So it is nothing but the present value of the bond, which is nothing but your current return. Okay, current prime, and the present value of the face value of the bond. One is you have the current value of the coupon payments, you have the current present value of the coupon payments of the bond, and next you have the present value of the face value of the bond. So if I have to equate this is nothing but my current return, and this is my capital return. I'll just write down CA here so that it will come to know that your capital return. That is the only difference. So concept wise, there is no difference as far as return calculation is concerned. Only thing is the words have been changed, and that is what creates confusion. In fact, if I have to find out the present return of the bond, it is nothing but it is ascertaining the present value of, sorry, it is ascertaining the present value of the bond, okay, in terms of its coupon payments, and here we are ascertaining the present value of the bond in terms of its face value. That is the only difference. Okay, to find out the value of the bond, what do we require? We require expected cash flows. That means how much of money has been invested, and we also know, we need to know what is your desired return. So only when we know how much of money have you put in and how much of return you are expected, only then we will be able to ascertain the price of the bond. Sorry, ascertain the price of the bond. Clear? So to ascertain the price of the bond, there are certain assumptions that we have to make, and the assumptions are that the interest payments are fixed over the term that and do not change. So if I decide that Rashmi has taken a bond with a face value of 1,000 rupees, okay, carrying 10% rate of interest for next 5 years, which means for next 5 years, for next 5 years, this rate of interest is not going to change. This rate of interest is going to remain as it is. That is what we say interest payments are fixed for the term. Okay, next, coupon payments. Coupon is nothing but, the word coupon means it is the interest payment. Whenever bonds pay interest, it is always denoted by the word coupon. Okay, so coupon payments are made every year. You cannot have that, out of the 5 years that Rashmi has taken the bond, I pay interest for the first year, I pay interest for the second year, third year and fourth year I do not pay anything. Third year and fourth year I do not pay anything. Directly whatever is overdue I will pay in the fifth year. If this is the case, then we will not be able to find out the exact price of the bond. So the second assumption is that interest has to be paid every year. Come what may, interest has to be paid every year. So she should get interest in third year also. She should get interest in the fourth year also. Okay. Next is bonds would be redeemed at par on maturity. That means at the end of the 5 years term, Rashmi is going to get back her 1,000 rupees that she has invested. This value should not be less, neither it should be more. Only then we will be able to find out the price of the bond. So there are some preconceptions that we have to understand as far as finding out the pricing of the bond. Now, next slide, when I take it, please don't get frightened by looking at the formula. The formula is actually very simple. It looks complicated, but actually it is not so complicated. Okay. Now, there are various methods by which we can find out the price of the bond. This is one way by which we can find out the price of the bond. Okay. This is C is nothing but your coupon payments divided by YTM. YTM stands for yield to maturity. YTM stands for yield to maturity. So this is the formula. This is one of the formulas that is available to calculate the price of the bond. Okay. Looking at the complexity of this particular formula, I don't recommend you to use this formula. Neither will I use this particular formula. Okay, since it's very complicated. On the other hand, I will use a very simple formula, which is this part. I will use this particular formula. It's very, very simple to understand, very easy to comprehend. and that is what I'm going to look for. Clear? So here, how do I write the formula? It is P is nothing but the price of the bond is equal to C. C is nothing but your coupon payment that you receive, present value interest factor annuity. I think you know how to estimate value through annuity tables. Okay, so whatever is my required rate of return, I have to know what is my required rate of return, and for how many years I have issued the bond. That is what I need to know by N. So I need to know annuity for that particular year for that required rate of return, and the number of years I am looking for, plus M is nothing but the maturity value. Maturity value is nothing but 1000. Maturity value is going to be 1000 into present value interest factor. Please understand, here there is annuity, here there is no annuity. The rest all the things in this particular bracket remain the same. Okay, now can anyone tell me what is the difference between present value interest factor annuity and just present value interest factor? Can anyone tell me this? Can anyone tell me what is the difference between when I write here? Okay, I wrote here P is equal to C into bracket present value interest factor annuity. Okay, for required rate of return for n number of years. Okay, plus I have written M, that is maturity value. Okay, into present value interest factor only for required rate of return for n number of years. Can you tell me what is the difference between this frame and this frame? Can anyone tell me this? Can anyone tell me this? What is that I'm talking about? Are you there? All of you? Yeah, Rohit, can you tell me the difference between what is present value interest factor annuity and just present value interest factor?
So C is like initial payment, and M is a maturity.
No, I know that. C is coupon payments, M is maturity. I know that. I'm asking you the value, the difference between what do you mean by annuity, present value interest factor annuity, and only present value interest factor. Can you please tell me?
So it is like payment in installments.
What is it?
Payment in installments. So
Which one?
annuity.
See, if I have to just explain to you annuity, I think Prag sir might have explained to you this well when he was teaching time value of money in your second semester FM. I think Prag sir might have definitely explained to you the concept of time value of money. And whenever we have to find out time value of money, we always take present value and the future values. I think he has also discussed that how do you estimate your loan amortization schedule. You arrive at your monthly equated installments, right? EMI or annual equated installments, right? Are you there with me? Are you able to understand what I'm
Yes,
trying to
sir.
tell you? I think Prayak sir might have told you that, how do you calculate a loan installment? Okay, you have a loan amount. We call it as in financial language, we always denote it by the letter as, loan, sorry, loan to value, LTV. We call it as LTV, right? So let us say I have taken a loan of 5 lakhs. I've taken a loan of 5 lakhs, and I have wanted to repay. I want to repay this particular loan in 5 years. How do you calculate the installment? How do you calculate the installment? I think he has told you about the concept called as loan amortization schedule. You have to differentiate what is the principal amount in this, what is the interest amount in this. Has he told you? Okay, anyways, I don't think you have studied that.
Yes, sir.
Anyways, I'm not going to go back to your second semester and tell you what is time value of money and how to calculate present value. I don't have that time to teach you all this thing here because we have other things to do, right? So this is a formula that you have to understand now as far as calculating the bond price or calculating the price of a bond. So it is C. C is nothing but your coupon payment. What is mentioned here? C is nothing but your coupon payment. M is your maturity value. Okay, R is nothing but your required rate of return. N is the number of years that you have to maturity, and of course T stands for the time to maturity. Okay, so there is a concept here called as T. Okay, so T is, in this case it is T here, but in the second equation there is no T, so don't worry about it. So in whatever the case is, T or N is nothing but it talks about time. In the equation which is on top, this particular has a concept called as T, which denotes time. Here we don't have T, here we have a concept called as N. Both the things talk about only one thing, that is time. Clear? So we are going to use this particular formula and try to find out how do we estimate the price of a bond. Clear? Now, do you have present value interest, present value annuity tables? Do you have present?
No, sir.
Do you know how to calculate present value annuity in Excel? Every time you cannot sit with a calculator, you cannot sit with the table and start calculating the present value. Do you know how to calculate time value of money, or do you know how to calculate annuity values in Excel?
No, sir.
Okay. So after this class, I'll tell you that also, because that is also a part of your assignment now. Okay. So I'll tell you that. Anyways, so this, I'm going to use this particular formula to estimate the price of the bond. Okay. So please make a note. The formula that I have marked or circled in red, please note that particular formula, because that formula is very important for us to calculate the price of the bond. Okay. Please make a note somewhere, because we are going to use this particular formula off and on as far as estimating the price of a bond is concerned. Okay. Yeah. Now, the same formula here, no change in the formula. Only difference is, in the previous formula, you had this formula was applicable only when interest was paid annually, once in a year. Okay, once in a year, if interest is paid, this is the formula that you are going to use. But on the other hand, if interest is paid 2 times in a year, okay, if interest is paid 2 times in a year, that is what it says, semi-annually. Okay, then the same formula, I'm going to use the same formula. Only difference is, here I have to divide C by 2. Present value interest factor annuity will remain as it is. I'm referring only to this particular formula. Please make a note, because this formula is comparatively easy for everyone to understand. I'm referring only this formula. So it is C divided by 2, because interest is paid 2 times in a year. Present value interest factor annuity will remain as it is. My overall required rate of return, I have to divide it by 2, because interest is paid 2 times in a year. So my required rate of return, I have to divide it by that particular time frame. And why I am multiplying it by 2n is because in a year, 2 times the interest is going to be paid. The word semi-annually means interest is going to be paid 2 times. First and second time the interest is going to be paid. For the first 6 months, Okay, I have to estimate the value, and for next 6 months, I have to estimate the value. That is the reason this formula changes. On the other hand, if interest is paid quarterly after every 3 months, if interest is paid after every 3 months, the formula is simple, same as it above. Only thing is, instead of dividing by 2, I have to divide it by 4. So here C divided by 4, present value interest factor annuity, R by 4, 4n, plus M, present value interest factor annuity, present value interest factor, R by 4, comma 4n. Now tell me, if interest is paid 12 times in a year, how will the formula change? I want Tejashwini, I want you to answer this.
Yes, sir.
Yeah. So if interest is paid 2 times, it is C by 2. Okay. Here also it is R by 2, 2n. Here also it is R by 2, 2n. If interest is paid 4 times in a year, it is C by 4, R by 4, 4n. And here also the same thing gets repeated. My question is, if interest is paid 12 times in a year, that means if interest is paid every month, how will the formula be?
It will be 12 times.
Agreed, but how will the formula change? How will you write the
C
formula?
by 12.
The formula would be
C by 12.
C by 12. Okay. This will remain as it is. Present value interest factor annuity will remain as it is. My R is going to be
R by
divided
12.
by 12, and here it is going to be
12n.
12n. Okay, plus M. Okay, M into present value interest factor only. Here also it's going to be R by 12 and 12n. Now, next question is, can I have Yutika, please? Yutika, if interest is paid every week, how will the formula work? I repeat, Yutika, if the interest is paid
Yes, sir.
every week, how will the formula change? How
Based
many
on
weeks are
the
there in a year?
4 into 12.
4 into 12 becomes 48. Do we have 48 weeks?
So, in a year,
Yeah.
So 52.
Yes, in a year we have 52 weeks. So Yutika, tell me, how will the formula change if interest is paid every every week?
every week.
Yeah.
C by 52.
Okay.
In the bracket, PVIFA.
Okay.
R by 52,
Okay.
comma 52n.
Fine.
Plus M in the bracket PVIF R by 52, comma 52n.
Fine. Tanas, if interest is paid every day, how will the formula work out?
Every day, so there are 365 days a year.
Okay.
So it would be 365. C divided by 365.
Okay.
Then bracket PVIFA R divided by 365, comma 365n plus M bracket PVIF R divided by 365, comma 365n.
Okay. Swapnil, if interest is paid every hour, how will the formula change? Every hour if the interest gets paid.
Okay, every hour.
Yeah, every hour.
1 second.
Next person, whoever I'm going to call out, remember you have to answer if interest is going to be calculated every minute. Okay, and next
8760.
and And the next person is, you have to calculate if interest is going to be computed every second. Okay, the point that I'm trying to tell you, as we keep on reducing the time frame, understand, as we keep on reducing the time frame, we calculated interest for year, then we came to half year, we came to quarterly, we came to monthly, then we came to weekly. Okay, next we came to, on daily basis, next we come to on hourly basis, now we are coming to every minute, and now we come to every second. Okay, so if you observe, the time duration has slowly started reducing. Okay, and at one point of time, you will not be able to differentiate between two successive time frames. If I go further down below a second, you will not be able to differentiate between a time frame. In such case, when you cannot differentiate between time frames and you still have to compute interest, it is called continuous compounding interest. Okay, so I think you might have not studied this. There is something called as ERT. E is nothing but an exponential term that we have to use. R is your rate of interest, whatever rate of interest that you want to compute, and T is for how many years or how many days you want to compute. Okay, so this is called e raised to RT. This formula, very soon you will be able to use it when we start calculating interest every second. When we start calculating interest every second, then we have to use this particular formula. Are you able to understand this? Anyways, so we are not going to calculate interest every second, but we will use a concept called as continuous compounding. So this concept is called as continuous compounding interest, CCI, continuous compounding interest. Okay, now we have as far as this particular unit is concerned, we are okay with half year compounding, we are okay with the quarterly basis compounding. But I have demonstrated to you, or I have told you, if time frame keeps on reducing on continuous basis, at one point of time you will not be able to differentiate between two successive time frames. When you reach that particular stage, the way interest is going to be calculated, that method we call it as continuous compounding interest. Clear? Fine. Now you will not be able to understand this premium bond and what is a discount bond and other things. We'll come to it at a later stage. Okay, but before we come to that part, it is important for you to understand how do we solve problems as far as pricing of bonds is concerned. Clear? So what I will do is, I will stop sharing this particular screen. I will share my Excel screen, and in that particular Excel screen, I will first demonstrate how do we use certain formulas and certain tools that are there in Excel to find out the present value of the bond. Clear? Or present value or the price of the bond. Is that okay with you?
Yes, sir.
Okay. Now pay attention, and if you want, you please make a note of this. Okay, I'm stopping the sharing of screen. Okay. We still have only 24 people who have attended this particular session. I want everyone to come in the video mode, please, so that I'll just take an attendance once. Because last moment, when the class is about to get over, a lot of people pop in just to see to it that their names come in. I'm not going to do that. We'll take attendance in between only. I want everyone to come in the video mode, please. Rohit, I cannot see your face. Okay. Akshata, Shaila and Vishnu, you're not seen. Okay. Fine. So now I'm opening my Excel screen. Just give me a minute. Yeah, if by chance the meeting gets over, please log in quickly, because I have to demonstrate how do you calculate present value, and also I have to tell you how to download the data from NSE website also. Okay. So if the meeting gets over, please log in quickly. Yeah, can you see the screen?
Yes, sir.
Okay. Now I'm entering some data. Don't worry about it. Okay. The question here is there is a bond. Okay, so I'll just write down as N. So the bond is issued for 10 years. Okay, the bond has been issued for 10 years. I hope it is visible.
Yes, sir.
Yeah, the bond is issued for 10 years. Okay, the rate of interest. Okay, rate of interest is 12%. Okay, face value of the bond is 1,000 rupees. Face value of the bond is 1,000 rupees. Okay, required rate of return. I'll write in short, required rate of return on this particular bond that I have is 13%. I want a 13% required rate of return. The question is, what should be the price of the bond? What is the price of the bond? Clear? So this is the question that has been asked to us, right? This is the question that has been asked to us. We have to find out what is the price of the bond. So if they ask us the price of the bond, what is the formula for price of the bond? P, right? P is equal to, what's the formula? Can anyone explain to me? C into bracket, present value interest factor annuity, okay, for required rate of return and for n number of years. I close the bracket, plus M is nothing but maturity value, which is nothing but 1,000 in my case, into present value interest factor, okay, for R, that is my required rate of return, and N, which is for number of years. Clear? Any doubts in understanding this formula?
No, sir.
Sure? Okay. So this is the formula that I'm going to use. This is the formula that I'm going to use to calculate the price of the bond. Now, before I come to the price of the bond, there are other things that I have to calculate. Can anyone tell me what is my C value here? What is C? C is nothing but coupon payment or coupon rate. What is the coupon rate? What is my rate of interest?
12%.
12%. So 12% of what? 12% of what?
So present value interest.
Now present value we are going to calculate. First, I want to calculate this only C. Can you see this C here? I just want to calculate C first. So what is the present value? What is the coupon payment? 12%. 12% of what? What is the face value of the bond?
1,000, sir.
What is the face value of the bond? 1,000.
1,000.
Right? So this is the formula that I'm going to use to calculate what is my C value. What is it? 120 rupees. Getting it? My C value is 120 rupees, right? So I know my C value. My M value is 1,000 rupees. I know that. R, which is mentioned in the bracket, is my 13%. Clear? This 12% I have used to calculate my coupon rate. There's a difference between this percent and this percent. This is my required rate of return. My required rate of return will always come here within the brackets. Okay, and this 12% that I'm going to use, it is my rate of interest or coupon rate on the bond. Please make a note of this. Is it clear? Fine. I will put this particular value in my equation. So 120 into present value interest factor annuity for R N plus M M in my case is going to be 1000 now into present value interest factor for R for n number of years. Done? Any doubts in understanding this part, please? Any doubts in understanding this part?
No, sir.
Now we have to calculate what do you mean by present value interest factor annuity. Please understand, I am just telling you how to calculate present value interest factor annuity. I'll just mention it here. Present value interest factor annuity. Okay. We have to calculate present value interest factor annuity for how many years?
3 years.
Where is 3 years? 10 years.
10 years.
Okay. And what is our required rate of return? So we have to calculate
13%.
interest for 13 years for 10 years. Getting it? We have to calculate present
Yes,
value
sir.
interest factor annuity at 13% for 10 years. Clear? Now, how do we do that? I'll just explain to you. Can you see a function based here? Can you see this fx?
Yes, sir.
So click on fx. The moment you click on fx, a window pops up. Okay. When this particular window pops up, look for financial. Okay, you can see here sum, average, count, max, sign, all these things. Okay. Go to most recently used button, click here on financial. Once you click on financial, all these financial formulas will come in. Now you need not worry about all these financial formulas. That is not required for you. That is not required for you, right? Are you able to understand what I'm trying to tell you? Okay, I'll tell
Yes,
you.
sir.
First, if things are getting too complicated, I'll do one thing. I'll first tell you how to calculate present value interest factor only. Forget about annuity. Annuity is a bit complicated. Okay, I'll first tell you how to find out present value interest factor only, right? Now, go to functions, click financial here, and once you click on financial, just make one click in this particular column and just on your keyboard press P. Okay, so you enter the P alphabets. Can you see here something called as PV? Can you see this here, something called as PV, present value?
Yes, sir.
Okay, click on PV. Okay, there's something that you see on the Excel and this window pops up. Okay, now here it is mentioned here as a rate. What is the rate? What is the rate that you are computing for? What is your required rate of return? 13%, right? So I'll write down 13%. Next, for how many years I want it? I want it for 10 years. Okay, don't worry about PMT. You leave PMT as blank. Go to future value. Okay, go to future value. After 10 years, Rashmi, how much money you are going to get? What is the maturity value that you are going to get?
1000, sir.
1000 is what you are going to get after 10 years. What is its value today?
It's the same, sir. 1000.
No, how can you see if you are going to receive 1000 rupees 10 years down the line, what would be its value today?
So, but the face value